Hey Facebook, this is Russ Story. I'm your host for Money Matters radio show on WDMG 97.9 and also Wave 94 in Tallahassee. So I thought, as we do sometimes, I'm going to do a Facebook Live while I record the show. This will be aired Tallahassee on Wave 94 next Friday. So you're getting a sneak peek. You're getting it early. But it'll be on Wave 94, 5 o'clock drive time in Tallahassee, and on WDMG 979 here in Douglas. You can listen to us at 11 o'clock on Thursday mornings. Money Matters, I'm your host, Russ Story. So we're about to get going here, so give me just a minute and we'll start the show. All right. This is Russ Story, your host for Money Matters. We are here on the radio today to talk about money because money matters. And we're going to discuss several things during today's show. I'm excited about today's show. I think we got a lot of stuff to tell you. We hope everybody's had a good week so far. It's good to be with you. Our regular listeners, thanks for tuning in. We appreciate you. And keep those cards and letters coming, as they say. You can check me out on the website at storywealth.com. Send me an email, rstory@storywealth.com. We get an awful lot of emails, and we enjoy getting them. We have a lot of questions. We have a lot of things come up. And one of the things folks are talking to me about now is about how to make the most money in the stock market. And, I don't get many questions about risks right now, and that concerns me a bit. We're going to talk about that a little bit today. I want to cover some current events, some things that are going on. Second thing, we're going to talk about a changing world. We're going to talk about how it's a changing world out there for the working man. And while we work hard and hopefully we've been able to provide, you've worked for a company maybe and they've got a retirement plan in place, we're going to talk about some announcements recently and what they may mean and sort of the trend of what's going on out there for the working man. We're going to talk about our forecast. We've had a fearless forecast out there. Well, we believed at the beginning of the year the Dow would hit 23,000, and it's rocking and rolling. It's 21 and change now. It's been moving up. We're going to talk about that. We got a change coming concerning our fearless forecast. I want to talk a little bit about what I call the bull-bear clock. And we're going to talk about an estate planning tool, something called a Q-tip trust. And I'm talking about a Q-tip trust. It's a Q-tip, something you stick in your ear and wiggle around to clean your ear out. But this is not the kind of Q-tip I'm talking about. So we're going to cover a little bit about that and what it can mean to you and your family as far as your estate planning is concerned. So without any further ado, let me jump into this. Current events, what's going on? Well, there's a lot happening out there. I want to talk a little bit about, while I'm on the risk theme, and I know many of you say, Russ, you're beating that drum to death. Well, when all the emails that I receive and all the phone calls that I'm getting, Russ, what tech stock should we be buying? Tech stocks are going up. We need to invest in Israel because their economy is going up, and everybody's looking blindly toward gain and how to make more money. We've had a pretty good year or two, and everybody's trying to figure out how to really capitalize and make more money. When Warren Buffett has a saying, and I think it's ingenious. He said, when everybody else is fearful, I want to be brave. And when everybody else is brave, I need to get fearful. And basically, I'm paraphrasing that, but that's what he said. Recently, I've been talking about the stock market. I've been talking about how I'm concerned about the valuation. I said I'm concerned because I believe that the stock market's rise has been really an anticipation and an optimism for Trump's tax cuts and some of the new supply side economic policies to take place and put into place. And we're a little bit concerned about that. Well, the Federal Reserve, there's a guy, investors have been really pushing the stock market up and moving things forward, and that's great. But hopefully these tax cuts and some of the incentives and some of the things that could increase corporate profits will come to pass. Hopefully this will actually get get done. But I believe that a lot of folks are overly complacent about risk. U.S. central bankers recently, one of the guys, his name's John Williams. He's San Francisco Federal Reserve Bank president. And he said he was in Australia, and they did an interview a couple of days ago in Sydney's ABC affiliate. Now, it's available on the internet, I think, now. But he said, the stock, and I quote, who does this sound like? Okay, check it out. Quote, the stock market seems to be running pretty much on fumes, close quote. I've been talking about how the valuation's too high. Things have gotten ahead of themselves a little bit. He said, quote, it's something that clearly is a risk to the U.S. economy. Some correction there. It's something we have to be prepared for, to respond to if it does happen, close quote. Well, I disagree a little bit because it's going to happen, okay? We can go back and look at the 33 times when the market's pulled back greater than 20% since 1929. It's always been this way. The stock has a tendency, you take 3 steps forward and 2 steps back sometimes. So I believe it's a matter of if, not when. He said if it does happen. I believe that it will happen. So you heard it from me. If you hadn't heard it from anybody else, you heard it from me first. Williams, who is giving a series of talks in Australia, said that for his part, he doesn't believe any Trump fiscal policies will begin to affect the economy until sometimes in 2018 or 2019. U.S. stock market indexes have set records this year. 19% climb in technology index. Williams said he doesn't see the U.S. heading into a dot-com style crash like it did in the late 90s or the year 2000, but because unlike then, the rise in stocks has been driven a fundamentally sound U.S. economy. He said he does say that volatility is near historic lows. I quote, I am somewhat concerned about the complacency in the market, he said. Well, let me tell you, John, here at Story Wealth Management Group, we're not complacent about the market risk. One of the things we've worked hard to do is to help our clients prepare for this situation. We want to make hay while the sun shines. We want you to make as much money as your neighbor and hopefully more. But one of the things we want to be prepared for is when that market pulls back, and it will pull back, in my opinion, and we want to make sure that you're in a position so that you can weather that storm. I was around in 2000. I saw the decimation of client accounts and the amount of money and net worth that was taken away and sucked out of their accounts. I was around in 2008, and that's when I made a determination to try and help my clients not to lose that to that magnitude again. So, and we've got some strategies in place. You know, I call it my buy, hold, and sell strategies, and I knock on wood, I believe that it will work well. We have some tried and true ways of investing that have been solid. It's not like they're pie in the sky. These are tried and true strategies and methods that we advise into our clients, and so that brings me to this point. My forecast for 2017 at the beginning of the year, here we are in July. My forecast was that the market would hit 23,000 by the end of the year. I'm backing off that a little bit. Okay, I'm cutting it to 22,000. So here for the last 6 months, I've held pretty tough to my belief that 23,000 was our number. It would at least hit that, and I was going to have a big celebration and giveaway when it hit. But the reality is I'm concerned about Trump's policies. I'm concerned about the lack of focus concerning pushing some of these tax incentives through, and I'm not quite as optimistic as I was at the beginning of the year that this would actually take place and happen. So I don't see a recession in sight right now. We don't take that for granted because we never see the snake till it bites you. If we saw the snake, and we could keep him from biting us, right? But so that's not a very pleasant analogy, but I think when it comes to my money and your money, it's important. And what I'm talking about here today and what I'm going to discuss with you are some of the things that we go over and some of the principles that we want to make sure that we're looking at. We're in a changing world right now. And so you heard it here. Russ has backed off his forecast. All right, so from 23,000, I'm cutting it back to 22,000. Hopefully it'll hit 23,000. I hope I'm wrong, but right now it just seems that maybe I'm a little more concerned than I was. Valuations in the market, the fact that we're probably overbought, these are some other reasons as well. So I want to talk about a changing world. We've got some things going on right now, and this is really more of the same. This is something that's been happening to us as American workers out here. UPS company just announced on Tuesday, I believe, that they would freeze employee pension plans. A growing list of American companies are freezing pension plans or transitioning over to 401k, defined contribution plans. 38 companies as in the Fortune 100 rankings have frozen their defined benefit plans, according to one source that I read. When the pensions are frozen, some of the plan benefits stop accruing. And so, and there were 7 companies that terminated their pensions entirely year to date. So some big companies, Fortune 100 companies, the pension plan seems to be on the way out. For new hires, 73% of Fortune 100 companies only offer defined contribution plans like the 401k. Defined benefit plans accounted for 71% in 2000 based on a Willis Towers Watson research. So what does that mean? Well, it means that we're continuing to move down the road. Companies are really taking the risk and transferring that risk for retirement over to the workers instead of the company having a pension plan. Used to, we had what we call a three-legged stool. You'd have government like Social Security, you'd have your personal savings, and you'd have a pension. Well, that's coming to an end. That's changing. Right now, the pensions are something that are really a thing of the past. It seems they continue to be kicked out. You know, if you're an employee, and let me say this, if this is something that you're concerned about your retirement, if you're 5 years before you're going to retire, if you're within that 5 years to retirement, say, man, me and my wife have planned it, you know, in 3 years I'm gonna quit this, you know, and I'm going to retire, depending on you. You know, if you're 5 years into retirement, in other words, if you've retired 3 years ago, and you know, if you're within that 10-year period, 5 years into retirement, or it's 5 years before you retire, I would strongly encourage you to come to one of our seminars. We're going to talk about a lot of different things. We're going to talk about risk. We're going to talk about the changing world. We're going to talk about the 3 biggest risks that I believe apply to you as an investor. And if you're a worker, and if you have a 401k, you are in fact an investor. If you have IRAs, you have other money that you are an investor. And we're going to talk about the 3 big risks as I see it. Bear markets. What happens when the markets go down? We're going to talk about that from a historical perspective and some ways that you can look at and consider to try to manage the risk of a bear market or the market going down. We're going to talk about inflation. How inflation is beginning to raise its ugly head. We're going to talk about taxes. Those 3 things, I believe those are 3 of the biggest risks that you can look at while in retirement. Bear markets, inflation, and taxes. You know, Y2K came along. How many of you remember Y2K? You remember the year 2000, all the computers were going to crash and everything was going to go into chaos and we were all going to be, living out of dumpsters. It was the financial markets were going to collapse. But one thing that did happen, stock market went down at one point about 50%. Okay, 50%. You're sitting here and you got your 401k, you have your investment accounts, and you're sitting here in what I call an unhedged, unprotected investments out here. Then you say, well, Russ, I don't have all my money in stocks. I got some in bonds. Well, that's got some risk now as well. We need to talk about that. You know, 15 years ago, my job was fairly easy. One of the things we could do, we could look at the old Harry Markowitz modern portfolio strategy and allocate. You'd buy some fixed income, you'd buy some equities to try to keep you on track and keep pace with inflation. The fixed income would provide us with some income. We'd allocate it depending on the age and the amount of money that we needed to pull. And guess what? It was fairly easy. We didn't know that back then, but looking at it now, based on our perspective, it was kind of easy. Now, not so much. Now you got a challenge. You got a bond market that's at the end of in my opinion, at the end of a 35-year bull. We're sitting here at rates that are at nothing on CDs and fixed income. They're very, very low. So, and then we got the stock market that, in my opinion, is fully valued. So I want to talk a little bit about something that I kind of, I kind of think is kind of applies right now. And a lot of people hadn't looked at it this way, but I was talking to Deborah and Kristen this morning a little bit, and it just kind of come to me, okay? And what I want to talk to you about is something I call the bull-bear clock, okay? Now, there's a few things I want to share with you. These are facts, all right? Facts. Did you know, since 1929, the S&P 500, the data shows, on average, bear markets occur every 3.5 years. So every 3.5 years since 1929, we've had a pullback. Now, they typically last about 10 months. They erase over, on average, 35% of the value. 35% gets drawn down every 3.5 years. And on average, it's taken about 3.5 years to recover. Now, I'd argue that it's taken us about 8 years to recover since 2008. All right? A lot of folks don't look at it. Boy, things are rocking and rolling. But the reality is we hadn't been at an all-time high for all that long. So it can really create some challenges, especially if you're getting ready to retire. You don't need to absorb that kind of hit. And we know that it's now every 3.5 years it occurs. If I told you it had been 7 years, would you say, wow, it's been 7 years since we've had a 20% decline? You'd say, wow, we're probably due. It's kind of time. What if I told you it's been over 9 years since we've had a market decline? Either you'd say that didn't apply anymore, they figured out a way to keep it from happening, or you'd say to me, well, Russ, we're certainly well overdue, about 3 times overdue, as a matter of fact, and it's something we should be concerned about. Well, currently that's our situation. So let's talk a little bit about the bull-bear clock, okay? Imagine, if you will, if you're driving down the road, just concentrate on driving, don't hit the guy in front of you. But let's say that you take a clock, and the top of the clock, 12 o'clock, we've got bull, and at the bottom we've got bear. So, in other words, if we know that the market goes up and down, but over time it goes up, which we certainly believe that will continue, we just know that we have cycles within the long-term cycle, okay? So if you said, well, when is the bear market gonna happen? Because we've certainly been in a bull for quite a while. Remember, it's been over 9 years, the average 3.5. So where do you think we are? If we've been doing well, okay, do you think we're at the beginning of a bull market? If it's been 9.5 years, and typically a bear market hits us every 3.5, I don't think anybody would say we're at 6 o'clock, we're at like 12 o'clock, right? Because that means the market's at a high and it's fixing to, or at a low. So, or let's say 6 o'clock, okay? That's that. So, it's at a low and it's about to start going back up because the market hadn't been going down, right? So we can pretty well eliminate the right side of the clock, I think, because we know that 9.5 years has occurred. So if we're about to go into another bear market, do you think we're at 6 o'clock? Well, we know this has been going on for over 9 years. I think we're at 9 o'clock, maybe, because remember, it's about to fall, at some point it's going to fall off the cliff up here at the top. It's going to hit 12 o'clock. Midnight's going to hit, okay? Are we at 10 o'clock, 11 o'clock? Maybe it's 11:45. We just don't know it because we never know when the clock's about to roll over. Unfortunately, we don't have that hand that tells us where we are. But I do believe that the analogy holds true, and I do believe that we're somewhere. I think most of you would agree. I don't know, Russ. We're probably somewhere between 9 o'clock and 12 o'clock. Well, when do we need to prepare for the decline? I think you'd agree we need to prepare for the decline when it's up high. So anyway, if you're investing and you're a trader out here and you're a professional guy who's on Wall Street, who understands the market very well, one of the things you run up on, most of the time folks will supposed to be. They know going in where they're going to sell. They know where they buy, and they also have a strategy for selling. And I believe if you don't have that, you're kind of flapping in the wind. Every trader knows going in where he's going to sell and where he thinks the intrinsic value is. If you have no strategy. Now, no strategy is perfect, but at least you got to have a system and you got to have a strategy. So, and I'm trying to protect you and I'm trying to protect my clients from what I believe is going to be another one of those bear markets where the investment accounts, the markets are gonna go down again. I think it's coming. Okay, so again, 3 big risks out here, especially if you're 5 years before retirement, 5 years into retirement. Bear markets, your value's going down, losing money, inflation, and taxes. And we're going to talk a good bit about that as well. I want to mention our current events. We got a lot of things going on. We got the seminars that are happening. We got that going on. We got let's see here if I got my notes here. Yeah, here we go. Seminars. I call it my summer tour. Okay, we got July the 11th will be in Perry, Florida. July 18th, we're having a webinar at 5 o'clock. On July the 18th, we're going to talk about the Mosaic Index and J.P. Morgan's deal with that and how, just talk a little bit about that as an investment. St. Simon's seminar is going to be on the 25th of July. Tallahassee will be August the 8th. Tifton will be September the 5th. And Douglas on 9/26 will wrap it up. But, I want to mention also, current event-wise, badges, the blood drive. For badges, we're having the 4th annual blood drive. It'll be out at Coffee Regional Medical Center. It'll be here in Douglas on the 10th of July from 12 noon to 6 o'clock. So that's going to be a good deal. Now, Kristen's on the board out there for that, and I know they do a great job and do good work. Our blood drive for Story Wealth Management up here, we almost doubled the amount blood donated that we had as our target. It was a big success. It was in honor of Levi Cason Rudd. That's Chris and Gail's son who passed away from SUD syndrome. So that was very successful, and I think hopefully we did a lot of good. So anyway, Bull Bear Clock, talked about the forecast. I want to hit you right quick with something that I'm about out of time, but I want to talk about a Q-tip trust. Every now and again, I want to throw something at you. Something comes up, I get an email, or I met with some clients, and this actually I met with some clients about this, and it came to mind. And I think this is something that you may want to consider in your estate planning. There's something called a Q-tip and a Q-tip trust. And, of course, all the attorneys know what I'm talking about to handle estate planning. But, it's basically, estate planning for couples who are in their second marriage or third marriage. Sometimes it can be tricky because you got stepchildren. One particular spouse is always going to be a little bit wealthier than the other. But one solution for the well-to-do spouse to maintain control of his assets but keep the other spouse taken care of is what I call a Q-tip, or what they call a Q-tip trust. Okay, now I want to talk a little bit. There's a lot of benefits. What does Q-tip stand for? Qualified Terminal Interest Property Trust. Okay, so it's a fancy term that basically allows one spouse to transfer an unrestricted amount of assets into a trust for the benefit and income of the surviving spouse. But it also provides that the spouse who gives the trust, who donates the funds, investments, whatever to the trust, gets to also control where that money is distributed after the surviving spouse passes. So if you've got children from a first marriage and the other spouse has, you can sort of manage that and pass. So married couples have estate plans that make use of the Q-tip. Typically, some attorneys call it an A-B trust strategy. And after the first spouse dies, the B trust holds the amount equal to the federal estate tax exemption, which is now, like $5.4 million. And then the A trust holds the excess. So it allows you to take advantage of the exemptions that you have to basically take care of over $10 million worth of value when it comes to your estate situation, so that you don't have to get into the estate tax situation. But a Q-tip basically qualifies for the unlimited marital deduction, I understand, and the property passes to the trust, won't be subject to the estate taxes until the surviving spouse dies. Q-tip, kind of a good idea, especially for some situations, especially when you've got a second marriage situation and you've got different sets of kids and you want to provide specifically for your spouse as well as those children and surviving children. Just a few things I'll mention about a Q-tip trust. The spouse may be entitled to receive all the income from the trust at least once a year. We set them up where we actually send the income out on a monthly basis for the spouse. The Q-tip trust, you have to file a federal gift tax form 709, and it has to be filed. So that's a little extra paperwork, tax time. But the spouse doesn't need to have the right to distribute principal from the trust, although it is permitted in some situations. So you can, if you put the money in a Q-tip, you can provide an income for your surviving spouse, but then pass on to your heirs as you've directed. You can, if the beneficiary spouse dies first, the grantor can become the income and principal beneficiary for the trust assets. So that's something that kind of protects in the event that, it's your surviving spouse, maybe your wife, she passes away before you do, and you didn't kind of expect that. Statistically, that wasn't what was expected. But some of the language in a Q-tip can seem a little bit restrictive, but it's really very flexible. Outright gifts to a spouse during life can lead to total loss control. This is a way that you can maintain some say-so and some control, but at the same time provide for that spouse. So, and pass it on to your kids. So just wanted to mention Q-tip. If you have questions about that or like more information, I'd encourage you to give us a call. I don't think I've even given you our phone number here today because I've been so excited about the stuff we were covering. 912-384-0030. Give us a call. Send me an email. rstory@storywealth.com. rstory@storywealth.com. We get an awful lot of emails. Keep them coming. Also, just want to mention, look us up on the internet. It's storywealth.com. Storywealth.com. Go in, look at the seminar schedule. You can sign up for a seminar right there online. That, or you're welcome to give us a call. We're going to talk about an awful lot of pretty cool stuff. We have this thing geared specifically toward folks who are about 5 years in before retirement, 5 years after retirement. If that's your situation, look at the situation, look at the dates, plan on bringing a friend. That would be great. We're going to have awesome chocolate chip cookies. That's my favorite part. And hopefully, at least we will have made a new friend. So anyway, I'm running a little bit over time here today, but I had a lot I wanted to cover, and it's always good to be with you. Thanks for hanging out. Hey, have a great weekend. I hope you have a lot of fun and fellowship. I hope you got some money to spend and can get out here and have a good time and enjoy yourself. We're going to do a little scalloping down at Keaton Beach, I think, this weekend, but don't tell anybody. But anyway, so have a great day, and God bless.